What I have for you today is a short description of a 345-page, I believe, decision from the US tax court on 3M. So let us start quick and look at the facts. As you can see, the US 3M company on the right held 3M Financial Management, which held 3M Innovative Properties, which held 3M Brazil. The 3M Innovative Properties issued licenses to Brazil, and Brazil paid royalties to 3M. The problem, in short, was that Brazil was not allowed to pay more than 1% of the sales as a royalty. So let us have a look at the detailed description of the facts, which comes from a summary of the US court itself, paraphrased. In 2006, 3M Company was a parent company of the 3M Group and owned the group trademarks. Other intellectual property was owned by 3M Innovative Properties, a US subsidiary. 3M Brazil was a subsidiary of 3M Innovative Properties. 3M Brazil used the trademarks owned by 3M Company through these trademark licenses with 3M under from the trademark license agreements from 1998. Under these licenses, 3M Brazil paid a 1% royalty of its sales of the trademarked products. Where the products were subject to more than one of the trademark licenses, 3M used the stacking principle under which the royalties were 3% if a product used trademarks under all three licenses. 3M Brazil also used patents and non-patent technology owned by 3M Innovative Properties, but paid no royalties or transfer payments for that. The 3M company reported the trademark royalties in its consolidated US income tax return. However, the IRS determined that the 3M Group income should be increased under IRC 482 to account for 3M Brazil's use of the intellectual property of 3M Company and 3M Innovative Properties. And if I remember correctly from the case, 3M reported around $5 million in royalties, but the US adjusted it with another $22 or $26 million for use of the trademarks, of the patent non-patent technology and transfers thereof. 3M Company argues that the IRC section 482, so the US transfer pricing rule, income should correspond to the maximum amount that 3M Brazil could pay under local Brazil law, less related expenses, and that the IRS did not take this into account. Now, what the Brazilian law said is, it said that when you pay these kind of license fees and royalties, etc., to a related party, the maximum that you can deduct is 1% of the sales. If the payments were made to unrelated parties, you could deduct whatever was agreed. But so it was a kind of an anti-abuse transfer pricing rule. The IRS, on the other hand, argued that the Brazilian legal restrictions did not meet the 1994 Regulation 26 CFR requirements for being considered. So the US issued rules saying, you know, when there are restrictions on payments, they must meet these and these and these conditions before we will consider them as, you know, not being payable and not open to a transfer pricing adjustment. Obviously, 3M disagreed, and 3M argued, one, that the requirements are invalid because they fail either the Chevron two-step test or part of the state farm test. And these were tests where the US government said, you know, when you make a regulation, it has to fulfill these and these conditions, right? If you interpret this statute, it must be because the statute is not clear, and then what the interpretation that you make must be reasonable, which includes, among others, that you must give taxpayers a chance to comment on your interpretive regulation. And 3M just said, you know, these things didn't happen, and part of that was part of the state farm test as well. And then it also argued that a 26 CFR regulation is invalid under Chevron Step 1 because the Commission versus First Security Bank of Utah case held that the IRS cannot allocate income to a taxpayer who did not and could not legally receive the income. Now, these are very US-centric points. They deal with US tax law in specific and US law in specifically, when are regulations allowed and when are they allowed to be applicable. I'm not going to look at that. What I want to look at is this denial of the deduction from a transfer pricing point of view under international transfer pricing law, and see how far we get with that. So if we look at the Title 26 CFR requirements for a foreign non-payment to be considered at arm's length, there were in 7 conditions. The first one is the restriction affected uncontrolled taxpayers under comparable circumstances for a comparable period of time. So if there is a limitation on payments, but it only applies to related party payments, you already failed the test. The Brazilian rules only apply to related party tests, so payments, so they already failed the test here. The second one was that the restriction was publicly promulgated, so it must just not be something in practice. To me, that would mean that it should be a written, published policy. The US court seemed to focus more on that it must be written, but it didn't really say a lot about whether it was published, right? But so it failed that test because it wasn't, not all of it was written, the US court decided. The restriction was generally applicable to all similarly situated persons, both controlled and uncontrolled, and if you fail test 1, then you more or less fail test 3 as well. The restriction was not imposed as part of a commercial transaction between the taxpayer and the foreign government. So the taxpayer needed to show that it didn't make a deal with the government. You know, if you do this, then, and if you say we can't pay, then we will do that, blah, blah, blah. And the court said, we don't think that happened here. The taxpayer exhausted all remedies prescribed by foreign law or practice for obtaining a waiver of the restriction, other than remedies that would have had a negligible prospect of success. And here the court said, you know, I think it's here where they said, you know, you could have just paid a dividend instead of paying a royalty. You could have paid something else. You could have repaid capital. You could have made that payment, but you really wanted to make it a royalty payment so you could get the deduction in Brazil. And so you did not do your best in making the payment. And then the restriction expressly prevented the payment or receipt in any form of all or part of the arm's length amount. Sorry, this is where the court applied that argument. The previous one is simply said we don't need to comment on this because you already failed the test before that. And then the taxpayer and related parties did not engage in an arrangement with controlled or uncontrolled parties that circumvent the restriction and did not materially violate the restriction. And again, the court said, you know, we don't need to deal with this because you failed enough tests already. So here's what the court summarized. They said, you know, the restriction must affect uncontrolled payments. Taxpayers, is this met? No. Is it publicly promulgated? No. Is it generally applicable? No. Was it part of a commercial transaction? You've met this requirement because it wasn't part of a commercial transaction. Have you exhausted all remedies for obtaining a waiver? Unresolved, don't care because you failed too many other tests, is what the court said. Restriction must prohibit any form of payment. Is this requirement met? No, because you could have paid a dividend. The taxpayer did not violate the restriction. Unresolved because they didn't care. So you can see here the court said, you know, you failed 1, 2, 3, 4 of the tests basically, so you have not passed this 26 CFR regulation. Are any of these requirements invalid under Chevron, the two-step approach? When was the statute unclear and was there was it a reasonable interpretation? And the court said it was not. You know, it said all of these tests are okay, and we don't have to solve the last 2 ones because we already said that most of the other ones have not been against the law. And what the court relied on heavily in most of this is in 1986 the US added the commensurate with income rule to the 482 law. So 482 said, you must deal with each other at arm's length, and then they added the second sentence, which said, by the way, if you've transferred some intellectual property, we can make a late adjustment if it turns out that the transfer price is not commensurate with the income that was subsequently earned from that transferred intellectual property. And this is an important point. It also, under the same argument, more or less, said that the State Farm and all the other cases were not really relevant because they all were from before 1986, or they didn't deal with the second sentence. Now, what interests me is the question of how much does this match with the OECD transfer pricing guidelines. If we look at Chapter 1D4, which deals specifically with the effect of government policies, it says there are some circumstances in which a taxpayer will consider that an arm's length price must be adjusted to account for government interventions, such as price controls, right? Controls over the payment of royalties, etc. Right? As a general rule, these government interventions should be treated as conditions of the market. So it's one of your 5 comparability factors. The question then presented is whether, in light of these conditions, the transaction undertaken by the controlled parties are consistent with transactions between independent parties. Would independent parties have concluded a deal like this? And then in 153, the guidelines say it should be considered whether or not an independent supplier would share in the costs of the price controls, and whether an independent enterprise would seek alternative product lines, whether they simply said, sorry, then we won't sell to you, right? And then in 154, they say a special problem arises when a jurisdiction prevents or blocks the payment of an amount which is owed by one associated enterprise to another. And then it says further down the paragraph, as a general rule, where the government intervention applies equally to transactions between associated enterprise and transactions between independent enterprises, the approach to this problem, where it occurs between associated enterprise, should be the same for tax purposes as that adopted for transactions between independent enterprises. So you need to look what unrelated parties do. And you can see the US actually, there's reference, there's a cross-link here, right, between the US saying, in order to get the deduction, it must apply to related and unrelated parties. I'm not saying that the US has followed what the OECD has done. It usually works the other way around, but at least these 2 conditions match. And then the final sentence is where the government intervention applies only to transactions between associated enterprises, there is no simple solution to the problem. Indeed, that is the problem. And it happens quite often. And then 155 says the difficulty with this analysis is that often independent enterprises simply would not enter into a transaction in which payments are blocked. But it seems unlikely that an independent enterprise would be willing to subject itself to substantial risk of non-payment. Even if the rules came into effect afterwards, and for products or services rendered by entering into an agreement where severe government interventions already exist. But the OECD says unless the profit projections or anticipated returns from the independent enterprise's proposed business strategy are sufficient to yield an acceptable rate of return, notwithstanding the existence of government intervention. So if you can still make enough money in spite of the government saying that certain payments can't be made, or you can only make so much of it, then maybe independent enterprise would engage into this. And this is not really a condition we see in the IRS, right? We don't see this in the CFR 29 or whatever it's called. One could ask if that could be one that could be added, right? And then it also says in 156, because independent enterprise might not engage in transactions subject to government interventions, it's unclear how the arm's length principle should apply. One possibility is to treat the payment as having been made between associated enterprises on the assumption that an independent enterprise in a similar circumstance would have insisted on payments by some other means. And here we see again the link with what the court said and the conditions from the CFR. If you can't make a royalty payment, make some other payment, make a dividend, repay capital, whatever, but make the payment, right? This approach would treat the party to whom the blocked payment is owed as performing a service for the M&E. So you could do one approach. An alternative approach that may be available in some jurisdictions would be to defer both the income and the relevant expenses for the taxpayer. So 3M in the US could not have taken the deductions in connection with the royalties, the development thereof, etc., until Brazil paid, right? In any case, the paragraph concludes the taxpayer should not be permitted to treat block payments due from an associated enterprise different from block payments due to from an independent enterprise. And again, they come back to this rule, which we also see in the CFR, and to that extent, I mean, the guidelines and the US rules largely match. Now the question is, can you even look at the guidelines? What does the treaty between Brazil and the US say? And now, first of all, from KPMG, we can see what the tax rates in Brazil were in 2006, and the tax rate was 34%, which included both corporate income tax and social contribution tax. I don't know if in the US you would be able to get a credit for social contribution tax, but that doesn't matter because we're dealing with the royalties only. But as you can see, you know, with such a high tax rate, there was not really a reason for 3M to move profit from the US to Brazil. So tax planning most likely was not an issue here. But that doesn't help 3M because they failed the CFR tests. And then the problem with the treaty is there is a pre-treaty, it's from 1967, but it never got ratified. I think it got signed but never ratified, so it's not in force, so the taxpayer could not rely on it. Interesting point was, if it was in force, it does have a non-discrimination article in Article 6, and one can wonder whether either Article 6 paragraph 1 or Article 6 paragraph 3 could have helped 3M to get these deductions. One could imagine that there's a scenario where if one Brazilian company pays a royalty above 1% to a related Brazilian company, that royalty is deductible because it will be taxed in the hands of the other Brazilian company. Or one could imagine a situation where if one Brazilian company pays to another one and both are held by a Brazilian shareholder, the payment is still deductible even if it's more than 1%. But the court doesn't say anything like that, obviously because the treaty wasn't in force. There also doesn't seem to be a bilateral investment protection treaty between Brazil and the US, which might have included a non-discrimination clause, so that doesn't help either. I think the most interesting international aspect of this case is the 7 tests that we've looked at. Whether they're valid or not valid under US rules is a pure US specific issue and not something we will look at here. Finally, I would just like to point out that this is probably not the end of the story. As you can see, here is the decision by the courts. 7 has agreed with the opinion that the tax authorities won. 2 have concurred with the results but not the reasoning, and 8 has dissented. So it's basically a 9-8, and not even really 9-8 decision. One would assume that 3M would appeal this case, and then it'll go to a district court before it goes to the US Supreme Court. I hope you enjoyed this video, and we will talk about another case next week. Bye for now.